Welcome back to the deep dive. If the global information landscape felt like it just accelerated from, say, cruising speed to Mach 5, you're not wrong.
You're definitely not.
The sheer volume of high-stakes, globally interconnected information we've collected this week is massive.
It is. It's largely driven by these huge geopolitical shifts and, some really foundational domestic policy reversals.
So that intense pace makes our mission today critical. We have to connect these disparate threads for you.
That's right. We're covering the immediate ripple effects of international flashpoints. The truly unprecedented events in Venezuela, the renewed tension over Greenland, and then we'll look at the volatility in U.S. markets.
Specifically, oil, defense, and housing.
Exactly. And of course, we have to analyze the rapid, almost feverish movement and, frankly, the staggering valuations dominating the tech sector.
Especially in AI and self-driving competition. We pulled together reports on everything from U.S. energy policy and defense spending to major corporate strategy shifts.
And even a total reset on federal nutrition guidelines. So the goal here is simple: speed and insight. We need to find the signal in this massive wall of noise specifically for you, the person who needs to understand the direct connection between, say, the U.S. seizing Venezuelan oil and how that might affect your own investment strategy.
Okay, let's unpack this, starting with the geopolitical catalyst that really shook the energy markets.
Right.
The immediate catalyst we have to address is the capture of Venezuelan President Nicolás Maduro and his wife.
On January 3rd and 6th.
Right. And then their plea of not guilty to charges in New York City. Our sources are calling this event, and I think rightly, unprecedented in modern times.
Absolutely. And the market reaction was textbook in some areas, but completely counterintuitive in others. Defense stocks, for instance, saw those initial surges globally.
In Europe, shares in Rheinmetall advanced 9.3%.
And in Asia, Korea Aerospace jumped 11% initially. And here's the divergence.
Right. Asian defense stocks pulled back the very next day.
They did. Meanwhile, the core U.S. indexes, the S&P 500, the Dow, they just hit record highs.
It's like they looked right past the geopolitical tensions, as if they were totally contained and irrelevant.
Which raises a critical question for you as an investor. Why? Why did the U.S. market show that resilience? Why did it decouple from the Asian pullback?
Our analysis suggests they're pricing in a very swift, successful resolution.
Or, and this is the other possibility, it's just pure, overwhelming domestic tech optimism powering the major indices, just overpowering any short-term global risk.
Let's get straight to the oil specifics, because Venezuela has the world's largest proven oil reserves.
According to that 2024 OPEC data, yeah.
And the U.S. announced it is seizing control of Venezuelan oil sales indefinitely.
With the stated goal being stabilization, to prevent it from collapsing into a failed state, which would be a discenter on every level.
And this is where the investment strategy gets complicated.
It does. Shares of U.S. oil companies reacted immediately. Chevron surged 6.4%. ExxonMobil, SLB.
That's the old Schlumberger, the services provider.
Exactly. They saw significant rises. And you have to remember, Chevron is currently the only U.S. major still operating there.
But if Exxon and ConocoPhillips see this as a chance to finally get their money back from that 2007 nationalization, the new administration seems to be tapping the brakes on that.
Tapping them hard. Energy Secretary Chris Wright confirmed that the massive arbitration claims, we're talking about $10 billion for ConocoPhillips, $2 billion for ExxonMobil.
Yeah.
He called them a longer-term issue, not an immediate priority. The focus right now is just on using oil revenues to stabilize the country.
Now, here's a crucial geopolitical nugget that links Venezuela directly to Moscow.
This is fascinating.
The sources show that U.S. enforcement actions have dramatically accelerated a trend of so-called shadow fleet tankers reflagging to Russia for protection.
And this is more than just a logistical shift, it's a strategic one. We saw the tanker Bella 1, which was running under a fraudulent Guyana flag.
Right.
After a U.S. port stop, it immediately reflags as Marinera to Russia. It's now sailing near Iceland.
So that sounds like Russia is actively creating an alternate protected financial and shipping ecosystem.
It is. This specific Trend 17 sanctioned vessels reflagged in a few weeks. It suggests Moscow is offering direct oversight and protection. This basically forces countries and insurers to pick a side, accelerating this bifurcation of maritime shipping.
If chaos over oil defines the shifts in the south, we need to turn north to the friction point that is Greenland.
Yes.
The White House confirmed it is considering a range of options to acquire Greenland, including the explicit option of utilizing the U.S. military.
citing national security, deterring China and Russia in the Arctic.
And this immediately sparked international pushback.
Of course, European leaders, especially Denmark, came out firmly. Greenland belongs to its people.
And it wasn't just rhetoric. Denmark announced it would spend 88 billion Danish kroner.
Which is what, about 14 billion US dollars?
Roughly $13.8 billion, yeah, on rearming Greenland.
So why? Why this frigid island?
It's three things: location, routes, and materials. It sits astride the GI-UK gap, that critical naval choke point between Greenland, Iceland, and the UK.
And the new Arctic shipping routes.
Exactly. And it has vast, untapped raw materials, critical minerals, rare earth elements, everything you need for new tech.
And while this prompted Denmark's massive rearmament, it's worth noting the domestic U.S. take.
Right.
Some Republicans on the Hill are viewing this as just negotiation strategy, the classic, art of the deal, not a genuine military threat.
Let's transition now from global geopolitics to the pressures on the U.S. domestic economy, starting with housing. It's still a massive affordability challenge.
It is, but there was some movement. The average 30-year fixed-rate mortgage ended 2025 at 6.19%.
The lowest since September 2024.
And that incremental drop is hugely impactful. The NAHB estimates that just a 25 basis point reduction, 0.25%, could bring 1.1 million additional households into the buyer pool.
And coupled with that is a huge policy intervention. President Trump announced immediate steps to ban large institutional investors from buying single-family homes.
Blackstone, Apollo.
All of them. The argument being that corporations drove up prices and pushed the American dream out of reach.
Which is a major market shock, especially for private equity. But it's happening during a period of fundamental migration changes. People are moving for affordability, for lifestyle.
Favoring smaller, cheaper markets. Oregon was the most popular destination in 2025.
Right. But wait, if developers and investors are already getting burned by oversupply in Sunbelt states like Arizona and Florida.
All right, that developer's remorse you mentioned.
Doesn't banning institutional buyers just limit the capital available to absorb that supply? Doesn't that risk making it worse?
That's the core tension. The policy is popular politically, but financially it's removing a major source of liquidity. Developers who are chasing these massive 6 to 8% rent growth projections are now suffering buyer's remorse because that growth just evaporated.
So what's the forward-looking strategy now for commercial real estate investors?
The pivot has to be away from that speculative residential growth. The sources suggest focusing on affordable housing, modest office parks in secondary cities, and retail that caters to middle to lower income segments.
So think discount grocers like Walmart.
Exactly. It reflects a structural shift in where Americans work and shop, and that shift is also visible in the labor market. The overall data signals a cooling.
Right. The job openings, the JOL test number, fell to 7.15 million in November, lowest since September 2024. Private payrolls added a modest 41,000.
And that JOL test number is key because the Fed had suggested that sustained job openings below 8 million were necessary to justify rate cuts.
So in theory, this data point gives the Fed what it needs to cut rates further.
But, and here's the paradox, there's this counter trend in construction.
Exactly. Construction job openings increased in November to 292,000, a 3.4% rate, even as residential fixed investment, the money spent on home building, continued to contract.
Down 5.1%.
It tells us the economic engine isn't just slowing, it's changing gears. That increase is supported by massive expansion in non-residential sectors.
Data centers. Industrial construction.
Yes. The economy is pivoting toward tech infrastructure, and that's offsetting the decline in home building. It's a critical structural change.
Now we shift completely into the realm of rapid sector transformation and the staggering valuation race in AI.
Just massive movement this week. Anthropic, a major player, signed a term sheet for a colossal $10 billion funding round.
Giving them a jaw-dropping $350 billion valuation.
And to put that in perspective for you, their primary rival, OpenAI, is currently sitting at an estimated $500 billion valuation.
These numbers are just stunning for foundational AI companies that, while revolutionary, are still pre-profitability at this scale.
And OpenAI is moving fast into highly sensitive areas like healthcare, which demands incredible scrutiny.
They launched ChatGPT Health. It's designed to let you securely connect medical records, wellness apps.
Like Apple Health, MyFitnessPal.
Right. Now, the critical privacy note here, which they heavily emphasized, is that these conversations will not be used to train their foundation models.
And it is strictly not for diagnosis or treatment. It's for personal health information synthesis.
Moving from pure software to the fusion of software and hardware, We see the autonomous vehicle rivalry heating up. NVIDIA announced Alpamayo,
A family of open AI models for AV development.
which is NVIDIA making a huge play to commoditize the training data for self-driving. But Tesla CEO Elon Musk immediately dismissed this as a near-term threat.
He said it would be 5 or 6 years before it poses a significant threat to Tesla's FSD.
He's making a very specific technical argument here,
It
right?
is. He's citing the immense difficulty of solving the long tail of the distribution.
Jargon for the 1% of scenarios that rarely happen.
Exactly. A deer jumping out of a trash can in the snow, a highly unusual construction detour.
Aye.
Things an AV struggles with. Musk argues that the gap between 99% and 99.9999% functionality is exponentially harder to cross.
We're seeing similar dynamic shifts in the airline sector, driven by economics and, well, politics. Let's start with the established carriers.
American Airlines is holding its elite status threshold steady for the 3rd year in a row. Gold still starts at 40,000 points.
So they're targeting higher spending travelers, focusing on yield over volume, matching rivals like Delta and United.
Right. And then you have the complete opposite pivot from the upstart carrier, Avelo.
They're cutting commercial routes, closing 3 bases, Mesa, Raleigh-Durham, Wilmington, and reducing jobs.
But this is a fascinating story because the primary driver wasn't falling demand. It was their decision to stop flying deportation charters for ICE.
Really?
Yeah. The CEO cited the revenue from this government work as unpredictable and pointed to the high operational complexity and costs and, of course, the political controversy.
That is a powerful statement from an upstart airline. To sacrifice a major, predictable government revenue stream because the operational complexity and political risk became too high.
It absolutely is. It shows how business decisions, especially for public-facing service, are now inseparable from political fallout. The reputational costs clearly outweighed the financial benefits.
Finally, let's wrap up with 2 key policy decisions affecting daily life, starting with what's potentially the most sweeping nutrition reset in decades.
HHS Secretary Robert F. Kennedy Jr. announced the new U.S. nutrition guidelines, calling it the most significant reset of federal nutrition policy in history.
And this is more than just a diet update. This is a fundamental policy pivot.
It is. The new food pyramid fundamentally reverses decades of advice. It emphasizes protein, full-fat dairy, and vegetables.
The core changes.
Prioritizing protein over carbs and explicitly ending the war on saturated fats. It's a move away from the lipid hypothesis that dominated federal advice for 50 years.
So full-fat dairy instead of low-fat.
Right. And encouraging cooking with things like olive oil, butter, or even beef tallow while heavily cutting highly processed foods.
And these guidelines will directly influence school lunches and federal nutrition programs,
affecting about 1 in 4 Americans.
Our final point covers a highly sensitive incident in Minneapolis that immediately drew sharp, conflicting narratives from government sources.
Right. ICE agents fatally shot a woman in her car.
The key takeaway here is the divergence in official claims, and we have to report impartially on both.
We do. A top DHS official claimed the woman weaponized her vehicle, attempting to run over our law enforcement officers in an attempt to kill them. An act of domestic terrorism.
But local officials who reportedly reviewed the video evidence strongly rejected this.
Very strongly. Minneapolis Mayor Jacob Frey and Governor Tim Walz called the DHS claims bulls and a garbage narrative, citing the video.
The mayor specifically criticized the reckless use of power.
And now the FBI and the Minnesota Bureau of Criminal Apprehension are investigating, trying to figure out what exactly happened amidst these radically different official statements.
We covered a tremendous amount of ground today. Quick recap. Massive energy market shock from Venezuela. Strategic friction over physical land in Greenland.
Fundamental pivots in U.S. housing policy and commercial real estate.
The feverish race to scale AI and a dramatic policy reset on nutrition.
And the unifying thread across all these sources is persistent volatility, especially that divergence between intense geopolitical friction over physical resources and land.
And the overwhelming long-term optimism we see in U.S. stock markets hitting record highs.
And tech valuations just soaring into the hundreds of billions.
And here's where it gets really interesting for you. The sources show Anthropic secured a $350 billion valuation. OpenAI is at $500 billion.
Highly speculative digital assets.
Exactly. Think about that. $350 billion for a company that mainly sells code and processing power. Meanwhile, back in the physical world, developers in Arizona are sitting on half-empty apartment complexes, suffering from buyer's remorse because their expected 8% rent growth just vanished.
And so you have to wonder, as all this money continues to pour into these highly speculative digital assets.
Believing they're the key to future growth and productivity.
Exactly. Does the market just fundamentally believe that the problems with real assets, where we live, the chaos over oil and
And
land,
there's a secondary.
or are they just that much harder to solve than the problems AI is currently targeting?